Today we dive into a new topic, apartment retention rates. With rent growth at historically high levels plus a lot of new apartment supply, what effect is all this having on apartment retention? Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons. Historically, it's been impossible to track apartment retention rates because we can't look at it through traditional survey methods. MPF Research now has access to that data through our parent company, RealPage. RealPage services nightly release transactional data for about 10 million units nationally through its software products, and we now have access to new metrics that were previously unavailable to our industry. And one key such metric is renewal conversion. What percent of expiring leases are being renewed? And let's take a look at the data. This chart shows you the share of expiring leases getting renewed by month going back 5 years in the SameStore Data set, and the results are pretty remarkable. Historically, the industry has tended to see rates around the mid to high 40s, but in recent years, as you could see, we've been in the low to mid 50s, and that's even in spite of rapidly rising rents and big levels of new supply, which logic would suggest should be driving down retention. And the fact that retention is still so strong speaks to the depth of demand for apartments and to the absence of any sort of affordability crisis in conventional investment-grade apartments. In July, 51.7% of leases that were expiring were renewed. That was on par with the July 2014 number. And in the SameStore data set, that marks 27 consecutive quarters without a year-over-year decline in renewal retention. And let's look now at some market rankings. And for rankings, we're going to expand the time frame to the trailing 12-month period ending in July to account for different seasonal patterns by market. And at the top, we have Milwaukee, and then the greater New York area, both above 60%, followed by Miami, Philadelphia, and Cleveland between 58 and 60%. And in the number 6 through 10 spots, we have Detroit, Hartford, San Francisco, Boston, and San Jose. So what's the common denominator with the top 10? Well, it's not rent growth. Aside from the Bay Area, these aren't hot rent growth markets for the most part. Rather, they're older, more mature markets, higher average age, lower job growth rates, certainly slower economies in the big picture, and therefore less mobility, which tends to mean lower apartment turnover rates. Now let's look at the flip side. Let's look at the bottom 10 for apartment retention rates among the nation's 50 largest markets. In this group, we have San Antonio, Salt Lake City, Jacksonville, Tampa Bay, Orlando, and Phoenix, all under 48% over the last 12 months. And then we have Denver, Indianapolis, San Diego, and Raleigh-Durham, just slightly higher. And what's the common denominator here? Well, these are generally younger markets with stronger job growth of late, and younger population plus more job growth tends to equal more mobility, which in turn means higher turnover or lower retention. So contrary to popular wisdom, though, low retention isn't necessarily correlated with low rent growth, just as high retention isn't necessarily correlated with high rent growth. In fact, as a group, the bottom 10 for retention rates actually outperform the top 10 for retention rates in terms of new lease rent growth and renewal rent growth. Now, of course, renewal retention isn't quite that simple. Low retention isn't necessarily better. It's achieving good rent growth in both renewals and in new leases requires a balancing act. It's a delicate act to get good rent growth. Now, going forward, what's going to happen? Well, our view is that retention rates probably can't get much better than they are. We should see some normalization occur with so much more supply now entering the market over the next 12 to 18 months, plus rents continuing to rise. But bear in mind that a little bit lower retention rates isn't necessarily a bad thing for the apartment market. As I noted earlier, lower retention isn't necessarily correlated with lower rent growth. In addition, lower retention does not mean people are leaving the renter pool. It just means they could be moving from one property to the next. So that'll be an interesting topic to watch going forward. We'll keep a close eye on it, but we're going to wrap it up today. So for Apartment Market Dynamics and for MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit